Hello, hello, hello. Welcome back to the Market Pulse channel, where we are your go-to source for all things finance. And today we have a topic that is causing quite a stir up in the market world. So buckle up, folks. We are going to be talking about the Warren Buffett Indicator. Now, if you're scratching your head wondering, what on earth is this Warren Buffett indicator? Don't worry, we've got you covered. This indicator is a favorite of Warren Buffett's, one of the most successful investors of all time. And right now, it is flashing red. So what's the deal with this indicator? Well, it's currently sitting at a staggering 182%. And to put this into perspective, Buffett suggests in a Fortune article back in 2001 that a 100 reading would indicate fair value for a stock or the stock market in general. So buying them at 70 or 80, that would be a bargain. But 200, you're playing with fire, my friend. So don't get too excited about just this quote from Buffett, because there is a lot more to this story. Other sources suggest that as of July 28th, 2023, that this indicator, the Buffett indicator, has moved up to this 182% at an all-time record high at also a record speed. And you have to keep in mind that this is 1.8 standard deviations above the historical trend line. So to keep it in simple terms, the stock market is looking pretty spicy compared to GDP, or highly overvalued. So why would you care about this? Well, the Warren Buffett indicator gives us a snapshot of the value of US stock market in relationship to the size of the US economy. If the stock market is growing much faster than the actual economy, we might be in what's called a bubble, right? Or a financial bubble of some kind. To dive in even deeper, the Wilshire 5000 is the total market index that has jumped 22% just this year, as investors are betting big on things like AI, rate cuts, soft landing from the feds, and the overall betterment of the economy. But with the Warren Buffett indicator flashing these numbers, we should be really cautious in just generally jumping into the stock market right now, as the values are really considered highly overbought and comparative to 2001's dot-com bust. Now, it's important to remember that no indicator is perfect, and obviously they all have their own biases. The market can be somewhat unpredictable and has many variables that you've got to stay informed about. But staying informed and making wise decisions is key to successful investing. And as Warren Buffett has said himself, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So keep that in mind as you're looking for value in the overall market. So does this news mean that you should go off and sell all of your stocks because the Warren Buffett indicator is highly overvalued? Not necessarily, but it might be a good time to review your overall portfolio, consider your new risk tolerance, and perhaps consult with a financial advisor on what move should come next for you. Now, I want to take you to one of my favorite websites that gives the current market valuation using the Warren Buffett indicator. In fact, it's called currentmarketvaluation.com. And I'm going to go through this site with you and kind of explain how to extract the most appropriate data. But here's where we're at, right? If you go to the top of the website, you're going to see aggregate US market value is currently at $48.9 trillion. The annualized GDP has come down a little bit to 26.9 trillion. And so the Buffett indicator is just really simple. You take the aggregate US market value divided by annualized GDP, and you get a certain percentage, currently at 182%. So if you scroll down, why does this matter? Well, historically, if you look at where we're at, July 31st, 182 ratio market value to GDP, that's 1.7 standard deviations above the trend. I think we said 1.8, it's like 1.7, 1.8, right? And so if you look at the historic moments that happened, look at when the last time we were in the 200 percentile. It was during the dot-com boom, where people were placing ridiculous bets into dot-com domains or into search domains or into this new thing called the internet, where we had very few winners. And frankly speaking, if you were to look at all the investments that went in and whether you would have missed some of the largest gains and the actual winners, you could have waited years after most people got in to grab the climb in the stock companies that actually lasted. You know, your Metas and your Facebooks and your Googles and Microsofts. All of those emerged after the main investment happened, prior to the drop and the fallout in 2001. So just because you're not in doesn't mean you're going to miss out on this AI revolution that's happening. If what happened in the past happens again, there will be a contraction in the overall market cap, or the overall, if we go back up to this, right, market value, which takes this specific indicator takes the Wilshire 5,000. So it's taking all of those companies and the total market value of all those companies. This isn't just the S&P 500. So yes, are there a lot of companies weighing this down? Absolutely. Are there right about now about 7 to 8 companies that are basically leading this market value? Absolutely. But this can all change relatively quick. That's pretty much it in terms of doing a deep dive on this Warren Buffett indicator. Obviously, this thing is going to change every single time there's an update to GDP or an update in the aggregate of the market value. So anytime this happens, the percentage is going to change. So I would be watching for sharp climbs, sharp declines, because the last time this thing declined, hit its bottom and then came back up, we were at pretty much the bottom of the market. And so if you had used this indicator and timed yourself back into this recent climb that we've had this year, you would have done relatively well. If you found that this video was helpful in any way, don't forget to hit that like button and subscribe for more insights into my financial content. And remember, guys, knowledge is power, especially when it comes to investing. Until next time, stay savvy, investors. We'll see you on the next round.